This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. Rob, thanks for taking some time to join me.
Good morning. Nice to be with you again.
Thanks for having us in the office. And Todd, as always, a pleasure, mate.
Thank you.
Rob, I might start with you. Soul Pat's recently achieved Dividend aristocrat status. What does that mean for you?
It's a staggering feat.
Yeah.
You mentioned the aristocrat. That in the last 27 years we've been able to increase our dividend. But before that, since 1903, we've never actually missed a dividend. And you go through the world wars, depressions, the recent period we've been through with the GFC and COVID. There's no other company that's listed as a record like that. It's staggering.
It's remarkable, isn't it? Yeah. How about for you, Todd?
For me, the dividend is really important because we pay our dividend out of the cash that we generate from the portfolio. So we can only pay increasing dividends if we're increasing cash generation across the portfolio. And our valuation is all about the cash generation of the underlying investment. So if our portfolio is generating more cash year on year, that means the portfolio is in really healthy shape. So that's a really good sign for us.
I'm led to believe that no one actually noticed when the aristocrat status ticked over, which probably speaks to the two of you and everyone here in the team just being so focused on business as usual.
Yeah, we don't go around blowing our trumpet. I think that's probably one of our reasons why we've been successful. We're sort of played under the radar a bit. We're not flashy people, we're conservative people. The company's always been run by good people.
It's remarkable. Like I said, so Todd, a lot of listeners will be familiar, not just with recent memory, with a couple of like mergers or acquisitions, long-term investment success, that type of thing. But since you've been in the CEO role, there has been quite a few changes, good changes, I should say. But I'm curious if we sit here in 2025, late 2025, what your vision for, the next decade is and how you could set the scene for shareholders.
Well, I think what I've been trying to do is capture the essence of what has made Soul Pat successful for such a long period of time and think about how I can apply some of those principles, whether it's the long-term thinking, disciplined investments, patient capital, defensive mindset, and then take some of our competitive advantages, which are the fact that we've got this beautiful permanent capital sitting on our balance sheet with complete flexibility to go anywhere. And how can I use all of that to continue to grow the business and make good investments and enhance what we're already doing? And so the idea is not to change anything, but to really just harness all of those things and take advantage of them.
I guess one of the things is to let people be familiar with the association with Brickworks for a very long time, right? So maybe this is a question for either one of you. Maybe Rob, if you want to start, is why was that something? Why is the Brickworks merger? Why is it something that's happened now? Like, why was now the right time?
Well, I think there's a couple of reasons for me. Is that the merger ratios sort of stack up at the moment. And I'll just go back a step. We never said we wouldn't do it. We've had a lot of criticism by a lot of people over a long period of time, but we never said we'd never break it down. And I think the other most important thing is we've seen some rationalisation with our competitors, CSR, Boral and Adbri, and over in the West, BGC. Brickworks was never in a position to do something if something does happen with those competitors. Whereas when we've joined the two together, we've got a very strong balance sheet here at Soul Pattinson, and if the opportunities do arise over a period of time, we'll be able to step up and take those on.
That's great. Would you add anything to that, Todd?
Yeah, I think Rob's right about the fact that we always looked at it. In my 21 years, I don't think there's been a year that we haven't sat down and thought, is there a way that we can structure this company better and achieve some uplift for shareholders if we were to do something? But the thing that's changed for me is the market environment and the growth of passive investing means that so much of the index weighting is important, and what we were missing out on from both companies' perspectives was that free float uplift that you get through the unwinding, and so we've increased our free float by about $4 billion. So obviously that has an important ramifications for index buying and institutional ownership.
We're just saying just off air before that there's a new substantial shareholder on the register this morning. So one of the things that for me personally, I think I represent a lot of shareholders when I say this, that the merger makes a lot of sense, right? And then the Milton deal, that made a lot of sense too. And so without, we're not in the business of trying to get non-public information here, but just generally speaking, do you see the deals like this on the horizon, or is this just because it was case in point, the circumstances were unique for these two companies? Is that something that you foresee will continue to happen?
Yeah, I don't think necessarily. Milton was strategically important for us because it gave us the capital to be able to diversify into those new asset classes and take advantage of the opportunities that we were seeing when we were historically a little bit capital constrained, because we had these really successful businesses that had low tax cost bases, and it meant that if we were to recycle any of that capital, we'd pay a lot of CGT, and that wasn't particularly beneficial for us to do. Whereas with the Milton acquisition, we were able to deploy some of those equities into these other asset classes. So that was a really important step for us. And I think you can see through the transaction activity we've done in the last 4 years, it's really ticked up, and we have ample liquidity to be able to do what we want to do. So we don't really need to do another one of those. And then Brickworks, was another opportunity for us to sort of clean up the structure, and it was important, but it was less strategic than Milton was. And so I don't think there's more of those that we need to do. I mean, we're now in a position where we've got the portfolio with enough liquidity to do what we want to do. The corporate structure's in great shape. So there's nothing on the horizon that I'd say that, that we need to do.
Fair enough. That's obviously very topical. I'd like to go back in time a little bit, and throughout the rest of this conversation, focus on the business, the team, these types of things, more enduring aspects of the Soul Patts legacy, if you will. So, Rob, I was just curious to ask you your earliest memories of finance, business, or investing, like things that you were being taught, maybe at a younger age, that are still with you today.
Yeah, I was very fortunate. The family we've always had quite a reasonable equity portfolio, and in those days it was Coopers and Lybrand, and we used to go to Canberra every year. And I can remember my grandparents in their 90s used to come down. It was on a family affair, and we'd sit in the offices in Canberra, and we'd go and have lunch together, which was for my grandparents was a great attraction because they were with the family and everything. But just going through those early days, I think the first time I went down, I was 8 or 9, and that sort of stuck in my mind that it's something I've always followed equities after that, and became involved through that early stages, probably when I was 8 or 9.
Wow. So that's not I guess not a typical conversation a lot of families have, but that kind of exposure early was so influential.
Yeah, I was very lucky, and we've always had my Jim particularly, who ran Soul's before me, was always a very passionate investor, no nonsense investor, and I learned a lot from him, particularly in later life when I joined the board.
I guess having those conversations early and just exposing children or so on and so forth to investing, to business in general, is just a really key lesson.
Yeah, I was very fortunate. I've had a very strong family grounding.
For sure. What did the business Soul Patts look like when you stepped in 1998? As I think that was the time you moved to chair. Was that correctly?
Yeah.
What did it look like? What was the business then?
Well, as Todd touched on earlier, we had sort of in those days 3 major investments. I was going to say TPG, but it wasn't TPG in those days. New Hope Brickworks and NBN Television, which eventually broke into what it is, the TPG today. We had a reasonably sized of $500 or $600 million equity portfolio. We still had some property, and of course we had the pharmacy, which was it didn't contribute the income that the coal mine did, for example. But I think the company had a market capitalisation of under $700 million. The share price was about $28, and we split the shares in 2002. And I think we were if we weren't the first, one of the first to split our shares. So when you look at, I think the market capitalisation today is about $17 billion, and the share price has gone from $8 when we split it now to over $40. So
yeah, wow.
It's just been with good people running the show, it's been a magnificent ride.
Yeah, absolutely it has, and there's plenty more to come. Over the years, as you alluded to before, there has been, some times where people, like outsiders, have maybe questions like, should the Brickworks, Soul Patts, be split up? And there's been a lot of things in the media and just things that you've had to deal with personally too. If you think back on your career thus far, what were some of the more maybe challenging times?
Well, obviously the most challenging side was I'm sitting in my office in 160 Pitt Street, and I get a phone call from Sir Ron Brearley telling me that he'd like to take Brickworks over. And I'd only been in the chair probably 6 or 7 months, so he probably thought there's an opportunity here, a young up-and-coming new chairman. And obviously that was a very, very testing time because I'd never been through anything like that before. And certainly it's led us into a path where today we have our own investment bank, Pitt Capital Partners, which now do all our deals and private equity and structural yield and all those sorts of things. So in some ways it was a great start to a new enterprise that we eventually still have today.
What was Rob, I'm curious, what was the nature of that phone call? When he gave you that phone call, what was he saying?
He said, we're going to take Brickworks over. I was dumbfounded. I didn't know what to say.
So you were on the back foot. You just said, I don't know what this guy's on about.
And then in that era too, you obviously had Sir Ron, you had John Elliott, Robert Holmes of Court, all these different people that virtually came in, grabbed the companies, split them up, took what they could out and virtually prostituted a lot of them. So I think with the cross-shareholding, we were in a very strong position to thwart that. And I think our performance over the long period of time has showed that that's been a very successful manoeuvre that old Bill Dawes and my uncle put together.
Well, that's one of the more challenging times. What would be, I was curious to pick your brain, what would be the investment decision, the capital allocation decision that you've made that you would say is something that you're especially proud of?
There's two. First of all, we bought NBN television for $38 million after Alan Bond and Christopher Skase had buggered free-to-air TV. A guy called Kevin Parry from the West owned NBN. And obviously New Hope from an old mine in Ipswich to Adaro to now owning Bengala and Ackland. And, for example, New Hope's paid $1.5 billion just in special dividends alone.
Wow. And
going back to Todd's point earlier, I think all those businesses that have been put together over that period of time were all great cash generators.
Yeah.
Because we talk about the aristocrat, but it's not, the aristocrat was running way since 1903.
Yeah.
So it's been a wonderful journey, as I said before.
When did you first buy New Hope, or the original?
Early 70s.
Yeah, wow.
We used to call it No Hope for a while.
What about you, Todd? If obviously your tenure in the business, so to speak, is shorter, but there's been a remarkable track record since you've stepped into your role, even more recently. What's been one of the things that you're more proud of?
Well, obviously, I wasn't around when some of those investments were first made, but I think I'm proud of our team's ability to take those investments and increase the value along the way. So it hasn't been a matter of just sitting on them for several decades and watching them grow. There's been incredible M&A activity both in what is now TPG as well as New Hope, and even putting the SP Telemedia and David Teo's TPG together was a fantastic deal. Those businesses were made for each other. We had the infrastructure, he had the customers, and then actually later that year, 2008, we sold the new Saraji undeveloped coal mine to BHP and Mitsubishi. $2.45 billion, top of the cycle. That was a fantastic deal.
We thought it was worth 1.5.
And we took some of that capital, gave it back to shareholders, but then we patiently waited until the market turned and there was a good opportunity. We turned that capital into Bengala, and after buying Bengala, that's paid us back multiple times in several years. So that was a fantastic way to sort of recycle capital into something much better than what we had.
I've got a few questions about different kind of asset classes and things like that throughout the conversation. But Rob, you've been in the seat for a while. You've seen things come and go. You mentioned the GFC before. I'm curious to pick your brain around moments in time when there might have been excesses or manias and things that you've seen over the years that you've thought, this is just getting out of hand. There's been a few of those moments, I'm sure, but if there's one or two that stick out to you, I'd be really keen to understand that.
Well, the GFC for us was a wonderful opportunity. I can remember buying Macquarie Bank for $14. I think 14 cents I was paying for TPG. Commonwealth Bank with $27. Commonwealth Bank have paid more than $27 in dividends since that period of time. The shares are worth about $160 at the moment. So that's one experience. But I think what we're going through at the moment is staggering when you look at what Apple are doing, NVIDIA. It doesn't seem to want to stop. And you look at some of the multiples that those big companies in America are on. And, when we were brought up doing basic investing, 13 or 14 time PE, now you're lucky to find anything in the market under 20. So we've got these inflated valuations in all these companies. There's a lot of the weight of money. 12% of our super is going into these type of activities daily. And one of the things that, to me, when we did merge with Brickworks, is there's one less company for mums and dads to invest in. And when you sit down over the last 10 or 12 years and see the magnificent companies that we've lost, and I know, and Todd will probably touch on this in a minute, but we're seeing a lot of private equity and people don't want to go into the public markets anymore with all the, the governance and compliance and things that are put on us.
So you think like there's a few different reasons there? There's like maybe fewer public companies. There's like a lot of money flowing from superannuation. Do you ever think about money supply, like generally, like the impacts of quantitative easing and money flowing into all assets? Is that something you think about a lot?
Well, there's a lot of debt around the world. I think that, to me, that's a major concern. A massive amount of debt. You've got to look here to see, the money that's subsidised, particularly in all these renewables, that money just throwing at all these various things. So again, that sort of worries me, as well as the high valuations in the equity markets.
Of all the investments that you guys have made, the one that always stands out to me is TPG. I don't know why, it just does. I guess it's something that I've followed for so many years. What made TPG such a wonderful business? And either of you can comment on this. I'm curious.
Well, I think it was a great business from the beginning because we focused on building infrastructure, and even when I think about early on when I was at Sols, one of the earlier investments we made was a business called Commendico, where they'd spent several $100 million buying or building East Coast fibre optic cable, and they were too early. I mean, as we know, that fibre is now incredibly valuable, but they were too early, and this happened all around the world. And SP Telemedia was able to pick that up for, I think, about $20 million. So we bought some just fantastic pieces of infrastructure at the right price that became the backbone, literally and figuratively, of that business. And so then when we found David Teo's business, he was able to overlay his strong customer base onto our infrastructure and make even more margin. And then from there, I think we really rode the data wave. There was so much more increasing use of data and mobile telephony, and it was just a great thematic to be on. Now, there's been some challenges along the way because I think the government has imposed some structural challenges, by introducing NBN to actually compete with private businesses. I thought was very challenging. We have some of the highest cost spectrum in the world, so it's effectively a tax on doing business in mobile telephony in Australia. So it hasn't been an easy ride, but we got the right theme, we got the right people, and we started building infrastructure at the right time.
I might just go back a step there. I mentioned earlier that we paid $38 million for NBN. We actually sold the TV station for $250, and as Todd just mentioned, what we've done with SP Telemedia. And that $38 million relates to a 12% interest in TPG today, which is TPG is valued at about, I think, about $9 billion. So you can see what $38 million is growing into.
It's fascinating to hear these numbers that the two of you are giving us right now, and to think, the way you approach investing just seems very common sense, very sensible, long-term, permanent, as you'll no doubt say. I often think about this problem that Buffett has talked about a bit in the US, is that as you get bigger, things become a bit more unwieldy, a bit more challenging, and you guys are definitely bigger and bigger every year. But there's one thing that I think, Todd, you've talked to me about before, which is this idea of being opportunity-led. And I feel like this is kind of a big part of the secret sauce. Did you want to just maybe explain to listeners and viewers what you mean by that?
I guess it's multifaceted. When we talk about opportunity-led, we primarily talk about it in the context of saying we don't have a defined portfolio allocation policy. So we're not saying we're going to have 30% to private equity and 20% to credit and 20% to property. Mm-hmm. We manage one portfolio of assets, and we just try to fill our bucket with as many good quality risk-adjusted return assets as we can, and in whatever form. I mean, sensibly. But theoretically, we could put one asset in the portfolio if we found something that was an absolute screamer. But really, it's about just finding good opportunities and executing on them. And when we find a good opportunity, we sit down with the team and say, well, is this better than anything else that we could be doing with our money? And is it better than what we currently have in the portfolio? And if it's better than what we've got, we sell our least favourite thing to fund it and recycle the portfolio so that we're constantly regenerating the portfolio into something better. And so that's why I say it's opportunity-led, because we're not sitting there top-down, it's bottom-up.
Yep.
But I also think, it has other connotations. I mean, we've just spoken about the journey of New Hope and TPG, and you have these assets that are your foundation that you can build upon. And so we look at those assets and say, how can we make them better? They are our opportunity set to be able to grow, to be able to conduct M&A and to facilitate their long-term growth strategy. So it's really just about finding those opportunities that suit your portfolio, but also finding new opportunities that are better than what you've got.
What would happen, so say something that does come to your table tomorrow morning, like we're sitting here in the office, do the two of you meet with the team daily, weekly? Like, what is that practical process of an idea getting surfaced and an opportunity becoming available?
One of the things I'm enjoying at the moment is I'm not day-to-day like I used to be. So I don't spend endless hours talking to people. So, Todd, you better answer the rest.
Well, I think that's been one of the evolutions of the business, is that we've now set it up so that we have many more people than we used to have. And we've set it up so that we can transact much more easily, because the scale is there, the liquidity is there, and when you have that process where you're constantly regenerating the portfolio with new good ideas, you want that to happen as fast as possible and as easy as possible and as frictionless as possible. So we've now got high quality senior team. They've got approvals to be able to transact without having to come up to the board level, to a certain level, of course. But they can make things happen, and being able to move quickly, I think, is really important. Because
that reminds me of the Constellation software kind of ethos as well. It's like up to a certain level, transactions are probably happening daily, but then obviously once you get further up, I was curious if we think about, well, I would characterise it as maybe an opportunity. Some people might say a bit of a challenge as you scale to continue to build that investment function. Are there any businesses or other investment houses or people that you look to as examples of the types of principles or processes that you incorporate here? So I mentioned Constellation Software, Danaher, Berkshire. Other businesses that you look at? Or not really?
Well, I mean, clearly Berkshire is a leading light in investments. I personally get a lot of benefit out of reading anything that Warren says or Charlie Munger's written, or Howard Marks and Ray Dalio and Stan Druckenmiller, all of those guys I think are incredibly thoughtful investors. Some of those other companies that you mentioned are real M&A powerhouses. That's not really what we're trying to do here. We're not trying to build the scale of the business. We're trying to invest our balance sheet in the best possible way that we can.
Yeah, okay. That's an interesting distinction. I like that. So I guess one of the questions that I got put to me by someone in our business was, Soul Patts is now quite diversified. You've structured yield or like private markets. You've got public markets. You've got these kind of cornerstone businesses. You've got whole businesses, parts of businesses. So in many senses, there is a significant amount of diversification. Whereas we think maybe back to the early 2000s or even at any time in history, there have been some really standout businesses that have powered a lot of the long-term growth. How do you balance the diversification with the conviction and the concentration that you might want to move the dial? And the reason I ask this, and maybe this is too simple, and feel free to push back on me here, but if I think about TPG, for example, I'm thinking, how many TPGs do the guys need to find now, for the next 20 years or something like that?
Yeah, I mean, I've spoken to a few people about that, and a lot of people are saying, where's the next big thing going to come from? And I guess there's a couple of answers to that. I mean, firstly, if I was to sort of use a test cricket analogy, I feel like we're at that part of the market where we're hitting lots of singles and just sort of trying to stay alive.
Yep.
And then there'll be a time where we swing for the fences, or Buffett calls that waiting for the fat pitch.
Yep.
So there'll be a time where the market has capitulated. There is no money around for anything. Some of those kind of bargain stocks that Rob was talking about are on offer. And that's when we can go shopping and we can really have a good swing at things. But I wouldn't say that we need to have one or two big things. I mean, we could do a $2 billion acquisition, or we could do 10, $200 million acquisitions. And I feel like there's probably more juice in the Australian market at the $200 million size than there is at the $2 billion size. So why wouldn't I do 10 200s?
Yeah.
I just feel like that's where we can get better risk-adjusted returns, and you get diversification along the way. Now, you can be too diversified. It's not really, we're not looking for hundreds of different things. But I think that if we can just keep finding high-quality assets, then we can't go too far wrong.
We talked about dividends at the top of the show. The track record, the investment track record of the Soul Patts team and business is remarkable. A common question you probably get asked, and I don't think I've ever asked either of you, is why would you pay dividends at all if your track record is so good?
Well, you talked about Berkshire.
Yeah.
They don't pay dividends. So if we earned $100 million here this year and we didn't pay dividends, we've got $100 million to spend next year, and that compounds over a massive period of time. Where we're paying 80 to 85% of our profits out in dividends. So, and obviously a lot of this has come around with what Paul Keating brought in with franking credits.
Yeah.
But this is why Buffett has grown so substantially. Because if you looked at our 120-odd year track record, if we never paid a dividend and compounded, we'd be a Buffett.
Yeah, absolutely.
Yeah.
So is that maybe if I dial in again, why not just reinvest?
Well, Rob's right about the dividend imputation. It's punitive to not pass on those franking credits to shareholders. It's tax that's already been paid on behalf of our shareholders. So it's important that we do pay a reasonable proportion of what we earn every year back to our shareholders, and that just makes financial sense. But sure, we could be bigger if we didn't pay dividends, and we could reinvest those dividends. But as I said before, it's not scale that we're looking for. It's to just keep focusing on the portfolio that we've got. It's not like we need more scale to do what we want to do. We don't need more capital to do what we want to do. So, we just want to do the most efficient thing, and paying a dividend to, as far as you can to soak up some of those franking credits is a good thing. Now, in our case, we actually have got massive amounts of franking credits. So we haven't done a good job of passing on those franking credits to shareholders, but that's really only been a function of our long history of successful investing. So when our principle is that the cash that we generate, we pay as dividends, the regular cash that we generate from our portfolio. But if we make a capital gain and pay some tax on that, well, we'll keep that capital alive for future investment. So you've got to find that balance. But because we have had such a long history of successful capital gains, we've got a franking credit balance of something like $1 billion.
Yeah, well, Buffett has often talked in the US about how he would value his own business. And you two are investors. You've been doing it for a very long time. Every time I come away from talking with you or hearing either of you speak or reading the annual reports, I just think, I've just got to buy more and more and more of this thing. But then I do the usual thing, right? And you can laugh at this. I would go in, I'd like, well, what's the dividend yield? What's the price earnings ratio? What's this? What's that? If you were trying to maybe augment shareholders' focus or even outside investors, and they're looking at Soul Patts like great business, run by great people, so on and so forth, how would you assess the business? Maybe not so much myopic and short term, but longer term. How do you assess your own business?
Well, we try to make it really simple for people because I don't know of any other company on the market other than the LICs that give the net asset value to shareholders, and we do that twice a year at every reporting period. Where we go through, and obviously there's a mark to market on all the listed securities, but then even on the unlisted stuff, we'll do directors' valuations and say that's what the portfolio is worth. And I mean, to some extent, that is a little bit detrimental because it anchors people to that value. Whereas, you talk about Buffett trades at sort of 1.6 to 1.8 times book, and I don't know whether his book necessarily reflects intrinsic value or not, but the way that I explain it is we're worth at least the sum of our parts. And then the question is, what value do you have on the intangibles? And that is the long-term track record of outperformance, the fact that people can get access to some pretty exciting asset classes, opportunities without paying a management fee. There's no external management fee leakage. So another way to look at it is the value of that embedded management company that shareholders own. Now, that's something that we don't put on our balance sheet. We don't have included in our net asset value a valuation on the management company. But shareholders own that, and that's worth something, and it's worth a lot. I mean, if you actually added up all of the management fees on assets that we are doing in-house that we're not paying somebody else to do, it'd be hundreds of millions of dollars of fee income that we're not paying every year. Now, put a multiple on that, that's actually worth something.
Yeah, for sure it is. That's a really good point. I hadn't thought about it like that. Yeah. So last time you were on, Todd, we spoke about the private credit market, private markets in general. Maybe this is a question for both of you. You mentioned, Rob, before valuations, these types of things. But as people have then turned their gaze to, well, what else is out there? Public markets, look at private. And obviously I represent this from the quote-unquote retail investor perspective, but also a lot of intermediaries listen to the podcast and that sort of a thing, financial advisors, so on and so forth. And you guys have been in that market, the private markets, for a long, long time, probably longer than almost anyone in this country. But now we're starting to see a lot more of that surface into our side of the fence, which is private credit, private equity coming direct, and a lot of buzz around that, not just here in Australia, but mostly overseas. I'm curious what you think about that writ large. So, Rob, maybe starting with you.
Well, obviously, New Hope and TPG, well, before TPG, but NBN were private equity. So, as you mentioned, we probably are the longest private equity people in Australia, and now we've gone on to bigger and better assets in that field. And as I mentioned before, is a lot of people coming through this door say they don't want to be in a listed environment. And I know now that the governance, and as I mentioned before, etc., takes up 3/4 of our time. We've had to put our board meetings on first so we can actually talk about what's happening within the company rather than talking about everything else that's supposed to be governing us. Todd, do you want to add a bit more?
Yeah, look, I think that there's been a significant growth in alternative asset classes in Australia because we were starting from a very small base.
Yeah, very much.
And I still think that the private credit industry in Australia is much smaller than it is in relative terms to most other developed markets. And I think people have also looked at, there's been a long history of very nice returns out of private equity, and you would expect that because markets have been good and the economic cycle's been strong, and leverage has been cheap, and when you leverage those returns, you get pretty good returns. So, of course, when people look at that, they say, "How do I get some of that?"
Yeah.
And so I think there is a lot more products being opened up to the retail and the smaller end, and because this used to be something that only really sophisticated and high end people could access. I think it's a good thing, but of course, it always comes down to the individual manager and the individual opportunity, and whether those fees for operating that business are fair, whether they're conflict free, whether they're doing things at the right time in the cycle. I mean, they're just standard operating procedure for making good investments. You need to carefully select who you're investing in and with, and the timing of the investment. But other than that, I don't have any real problem with the idea that we're democratising access to alternative asset classes away from pure equities, where Australia was very heavily weighted.
I feel like you guys have this kind of gravitational pull around you in private markets. I think it'd be fair to say, in some respects, because of the reputation that you have with being permanent capital, whereas you could, say, go to a traditional PE firm and even if you're a business owner or a previous owner of that business, a vendor, you kind of know what is to be expected, versus, say, if you knock on the door here at Soul Patts and you have a conversation, it's probably, it's going to be a different type of conversation. And I think there are a lot of other successful businesses around the world in this regard that they want to be the safe place for the business to go. The vendor or the seller, the owner, doesn't want to sell it to someone that's necessarily going to pillage it, right? And so I think that reputation would, over time, give you a structural advantage in this industry.
I might just start and then Tom could finish again.
Sure.
I go back 4, 5, 6 years ago when we first started doing this in a serious way. I used to get the feeling that we were 7 or 8 or 10.
Right.
Before some, people had come to us with a deal at 6 or 7, as I said, or 8 people had probably looked at it and hadn't taken it on. But the success Todd and his team have developed around these businesses, we're now 1 or 2. So if someone walks in the door, they're fair income, they're looking to do something with us, not someone else.
Yeah, absolutely.
Yeah, because of our track record and the people that are here.
But I think the reputation was always there. The thing that's changed is our ability to deploy capital. I mean, I talked about that earlier. We now have the ability to do deals. And of course, when you do deals, then people want to bring you more deals, and it sort of feeds on each other. But there's no doubt that we are the beneficiaries of a fantastic reputation, track record that Soul Patts has had. And you're absolutely right. I mean, people want us on the register.
Yeah.
They know that we're going to be supportive for the long term. They want to come talk to us about credit because they know that we can be more thoughtful and flexible than some of the other people who are very constrained about a very strict mandate about what they invest in and how they invest and what that looks like. Whereas we come and say, well, we can have a conversation that looks like equity, it looks like debt. Let's think about what works for both of us. And there's not many people that can do that. Yeah.
And that's where, like you said, the industry in Australia was very nascent there for a while. Once the big banks have stepped out in a big way quite a few years ago, it kind of left this big void there, which you guys are now playing in, which, to your point before about not having to swing for the fences or not having to find the next big thing, I feel like that part of your portfolio kind of underwrites a given level of return, like risk-adjusted return, because you're that kind of home of some, is it small or mid-market capital? It's mid-market private credit, right?
Yeah, I'd say we're more at the mid-end.
Yeah. You're that home, and that's kind of a way for you to deploy capital consistently at really compelling risk-adjusted returns, which underpins something that the public can't get, right? Yeah. So it provides that kind of like that floor on the returns going forward. Rob, you said before, I wanted to talk to you a little bit about culture. You said before that maybe not necessarily on the tools each and every minute of the day now, but I did hear from someone that you do walk the floor daily. So why is that important to you?
Oh, I just think, I don't want to be seen as a silly old fart chairman sitting in his office. I don't smoke a cigar. But, we've got a team here, and Todd's the leader, but I'm sort of the acting captain, I guess, in some ways. And it's like, if you've got a good team, I enjoy walking around and ask some of the boys or the girls, what are they doing today, or what are they working on next week, or are they enjoying themselves? Like, it's a Monday morning here. I've just been around and asked them, I had a good weekend, and talked a bit of footy and talked about people going to the beach and these sorts of things. But I just find that enjoying, and that's been one of the great cherishes that I've had over a long period of time is going to a coal mine or going to a brick factory or going somewhere else where we actually own a business and talking to the people that run the business. This business has revolved around people. Amazingly, the good people we've had, not only within Soul Patts, but our investee companies. Because again, they wouldn't have been successful unless we had good people running those.
For sure, for sure. Maybe it's a question for both of you, is how do you retain such good people for such a long period of time? Because Rob, I was chatting, I think it was to Dean last time, and I think he's been with the business for 20 years or something, and he said he was one of the newer people. So how do you retain people for such a long period of time?
I just think it's our culture. People work together here. No one, sort of is an odd bod, or I think we've had that ability to pick good people. I'm down to earth. I drive an $80,000 car. The company's never owned a boat or never owned a plane. We've always had our feet on the ground, and I think that's continued on for generations. I remember when we had the pharmacy business, we had 3 families of 3 generations worked in the business. So it's always, going back 100 years, it's always been a good place to work.
That's great.
And we try to, and we make it attractive for people. Friday nights here, the bar's open at 3:30, 4 o'clock, and we get around and have a drink together and talk, and the management organise a few things during the year that we do and keep people in touch with things. It's
a good place to work.
Well, you've got to make it. This is one of the things that staggers me in this day and age, is people working from home. We've got 58 people here and they come in every day.
Yeah, right.
You cannot run a business without people on the ground.
Yeah, I heard something the other day that people don't quit their friends. So if they like the place where they are, they feel like they're seeing their friends every day, or family, or whatever the case may be. You just don't quit that. You want to come in, you want to feel like you enjoy the place, and you spend more time.
And you've got to make it comforting for people to come in.
Yeah, for sure. For sure. Well, you've got a few more folks to add to the office space or something like that. The challenge for you guys over the next little while with Brickworks and Souls now together, which is a good challenge to take on. One maybe for you, Todd, as well, is just around this idea, the teams being aligned by group performance, because I think we've spoken in the past, and I don't know if we fully hit this, which was you've got different people making different decisions in the business. In some firms, it would be natural that people might compete against each other because they might compete for budgets, they might compete for time in meetings, or whatever the case may be. But it's group performance that matters here. How do you foster that?
Yeah, I didn't really appreciate how unusual it was. But whenever I speak to anyone else in asset management land, they say, we just can't get our heads around what you guys are doing over there. And I think it's partly cultural in the way that Rob really sets the tone of the culture, and we're here for shareholders and not for ourselves. That's an important kind of trait that everyone carries. But it's also the way that we've set the business up. I mean, even though when we explain to our shareholders what's in the portfolio, we break it up into other portfolio parts, but it's actually not the way that we run the business. Right. The way that we run the business is one single portfolio, and that's important because that comes back to what I was talking about earlier, that the best opportunity makes its way into the portfolio irrespective of what asset class it is. And so if I had particular allocations to each portfolio, then there would be no need for them to talk to any of the other portfolios because they would just be managing that allocation and doing the best that they can. But actually, they are in competition. So we're promoting competition, but not amongst people, amongst ideas and amongst investments. And so they are constantly in competition with each other's ideas and each other's capital so that the best one wins out. And the only way that can really happen is that you do have that dialogue and you do have that frictionless movement of capital into the portfolio and out of the portfolio. And also that the way that you remunerate and reward people and incentivize them is based on their cultural attributes of being able to function in that environment and promote that idea of winning for the whole team rather than individually. So if you're in a typical asset management company, your performance or your rewards would be a function of your performance, but also your funds under management. And so people would be very protective of the capital that they manage.
For sure they would.
Whereas in our environment, we take that away and we say, actually, it's about group performance. And so clearly your own contribution matters, but the capital that you're managing is less important than the overall performance.
Now I've only got one more question maybe for you, Rob, but I know that you guys get on the road quite a bit as well with shareholders, and you really appreciate that dialogue. So maybe I'll just call that out for anyone that is a shareholder. The guys do get on the road, and I think they can head to the Soul Patts website and find out more about that. It's also information in the ASX updates and those types of things. So if you do like the podcast, if you do like seeing and hearing the guys today, and you're a shareholder, engage as well is what I would say. Obviously, you've been very generous with your time today, but I've got one more question for you, Rob, which is what excites you about the outlook for Soul Patts?
Just before we go on that, I'm not sure when you'll have this podcast out, but next week we are having shareholder briefing in Sydney.
Yep.
On Tuesday, Melbourne on Wednesday, and Adelaide on Thursday. And obviously shareholders will have been notified.
Yep.
But I think it's a golden opportunity for them to come and listen to Todd and his team to explain how we're going around our various activities.
For sure.
Well, I think the history, and we're 125 not out in 2028. I'm going back to Todd's cricket phase there earlier.
Yep.
I'd love to be here for that. And maybe a little bit longer. But I just feel with the team that Todd's put together, we're achieving these goals, and I think we're going to become bigger and better over a longer period of time. And may that their Dividend aristocrat continue to grow for many, many years to come.
Great. I like it. And I think it will. So I like that optimistic way to end things today. Todd, as always, thanks for joining me.
Thank you.
And Rob, I really appreciate it.
Always good to see you. Thank you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.